Hello and welcome to the Stocks Knock channel. This week, we bring you an overview of stock market developments over the past 2 weeks, an analysis of the causes of the market downturn, and an outlook on market trends in the upcoming period. The September 2024 stock market crash can largely be attributed to a confluence of weak economic indicators both in the US and globally, which set off alarm bells for investors. Following consecutive months of disappointing economic data, including weak job openings and declining manufacturing output in both July and August, investor sentiment deteriorated sharply. The underperformance of the U.S. labor market, which is a critical indicator of economic health, heightened concerns about an impending recession. This growing uncertainty triggered widespread risk aversion, prompting a substantial sell-off across major stock indices, as investors sought to protect their portfolios from potential economic downturns. The lack of robust growth signals contributed to a heightened sense of market vulnerability, amplifying fears of sustained economic weakness. Internationally, market instability was further aggravated by deteriorating economic conditions in China, where growth had been decelerating for several months. As the world's second-largest economy, China's prolonged slowdown sent ripples through global markets, heightening concerns about the potential for a broader global economic downturn. Meanwhile, Europe's financial markets also played a role in the sell-off, as persistent geopolitical uncertainty, coupled with underwhelming manufacturing output, undermined investor confidence across the region. These factors contributed to a highly volatile global environment, in which domestic and international uncertainties fueled widespread risk aversion and significant sell-offs across major equity markets. The already fragile economic outlook in September 2024 was significantly compounded by concerns over central bank policies, which played a key role in driving the stock market crash. Investors were increasingly wary of additional interest rate hikes from the U.S. Federal Reserve, following previous increases aimed at curbing persistent inflation. Although inflation had shown signs of easing, the Fed's commitment to tightening monetary policy raised fears that elevated borrowing costs would stifle economic growth, pushing the U.S. economy closer to recession. These concerns were not confined to the U.S. The European Central Bank and the Bank of Canada had similarly indicated their intention to continue raising interest rates, reflecting the global nature of monetary tightening efforts. Central banks were navigating a delicate balance, attempting to control inflation without triggering a full-blown economic downturn. Historically, markets have proven sensitive to central bank policy shifts, and the uncertainty surrounding further rate hikes, combined with mixed economic signals, helped widespread risk aversion. This led many investors to sell riskier assets in favor of more secure investments. Market volatility in September is not uncommon, but the conditions in 2024 were especially precarious. The month has historically seen weaker market performance, a trend often exacerbated by reduced liquidity as traders return from the summer soothe. Adding to the volatility was the U.S. presidential election, which further destabilized markets as investors grew more cautious, anticipating potential shifts in economic and regulatory policies. All this combination of factors led to heightened instability, contributing to the broader sell-off that marked the September crash. Investor sentiment, or should we rather say fear factor, played a pivotal role in the market downturn. Following a swift recovery from the near correction in July, valuations had surged, particularly in tech stocks. Many analysts had cautioned that the market rally preceding the September 2024 downturn was unsustainable, as it rested on tenuous foundations. Elevated market valuations, particularly in high-growth sectors, were increasingly viewed as out of alignment with underlying economic fundamentals. These concerns were compounded by slowing economic growth, which signaled that the robust performance seen in previous months was not reflective of broader macroeconomic realities. As these warning signs became more apparent in early September, market volatility spiked, culminating in the sharp sell-off. The fragility of the rally, driven more by speculative optimism than by strong economic indicators, ultimately led to a rapid deterioration in investor confidence. A key technical indicator of the growing market instability was the rise of the Volatility Index, VIX, often referred to as the fear gauge. The VIX surged during the first week of September, indicating a sharp increase in market anxiety. As volatility rose, investors began to sell off higher-risk assets, leading to a broad-based decline in stock prices. In particular, the VIX spiked to levels above 16 on September 2nd, reflecting heightened concerns about the direction of the economy and market. Some traders had even placed significant bets on a further rise in volatility, anticipating additional turbulence leading up to key economic data releases later in the month. On the global front, all major indices, including the Dow Jones, S&P 500, and Nasdaq, experienced sharp declines as the selling pressure intensified. The September 2024 market crash had a profound impact across multiple sectors, though certain industries were disproportionately affected due to their sensitivity to changes in economic growth expectations and borrowing costs. Financial, energy, and technology stocks experienced some of the steepest declines. Financial stocks, particularly banks, were hit hard by the prospect of higher interest rates and a subsequent slowdown in lending activity. This was exacerbated by concerns that rising borrowing costs would stifle economic growth and reduce corporate profits. Energy stocks, on the other hand, faced downward pressure due to falling oil prices and fears of reduced global demand, particularly as China, the world's largest consumer of oil, continued to experience economic difficulties. In Europe, stock markets were similarly impacted. Key sectors such as financial services, manufacturing, and energy led the declines, driven by heightened concerns over slowing economic growth and rising interest rates. Financial institutions, particularly banks, faced sharp declines due to the potential for tighter monetary policy from the European Central Bank, which raised fears of reduced lending activity and profit margins. Additionally, the European automotive sector, already contending with supply chain disruptions and regulatory changes, saw further pressure as investor sentiment soured. The ongoing conflict in Ukraine and its impact on energy supplies heightened fears of an energy shortage, particularly as winter approached, leading to sharp declines in energy stocks across Europe. The combination of economic and geopolitical instability created an environment ripe for panic selling, resulting in accelerated losses across European markets. The regulatory environment also played a role. New guidelines from the European Securities and Markets Authority, ESMA, aimed at increasing transparency and mitigating systemic risk, contributed to short-term uncertainty among investors. While these measures were designed to enhance long-term market stability, the immediate effect was increased volatility, as market participants sought to reposition their portfolios in response to the regulatory changes. The technology sector, a major driver of market gains in recent years, also suffered during the sell-off. High-growth tech companies, which had been trading at elevated valuations, were particularly vulnerable to a market correction. As a result, tech-heavy indices like the Nasdaq experienced significant declines, further deepening the overall market downturn. As investors enter the final quarter of 2024, the outlook is marked by significant uncertainty. Analysts are divided. Some express cautious optimism regarding potential dovish shifts in central bank interest rate policies, while others highlight persistent geopolitical risks and fragile economic conditions that could heighten market volatility. Additionally, the upcoming U.S. presidential election in November introduces further unpredictability, as markets often react adversely to political uncertainty. In the near term, many analysts recommend a defensive investment strategy, emphasizing stocks with robust fundamentals and low volatility. Sectors such as consumer staples and utilities, known for their stability during economic downturns, are expected to offer greater resilience amid potential market turbulence. Meanwhile, ongoing scrutiny of inflation, interest rates, and economic data releases will most likely contribute to market fluctuations in the coming weeks and months. The stock market decline observed in September 2024 was influenced by a complex interplay of weak economic indicators, central bank policy ambiguity, and fragile market conditions. In the U.S., disappointing jobs data and underwhelming figures in job openings and manufacturing output raised concerns about economic recovery and recession risks, leading to significant sell-offs. Internationally, slowing growth in China and instability in Europe further amplified market fears. Central bank policies also played a crucial role, as anticipated interest rate hikes from the U.S. Federal Reserve, along with similar moves from the European Central Bank and the Bank of Canada, heightened investor anxiety about economic growth. The uncertainty around these policies, combined with a historically volatile September and upcoming political events, contributed to the market downturn. Investor sentiment was notably negative, intensified by rising volatility, as indicated by the Volatility Index, VIX. Key sectors such as financials, energy, and technology were particularly hard hit, with notable declines in major stock indices globally. Looking ahead, the market outlook remains cautious as investors approach the final quarter of the year. The potential for ongoing volatility is considerable, leading to a shift toward more prudent and defensive investment strategies. Thank you for watching. Hope you liked this video, and if you did, hit that like and subscribe button. See you next week.